this month marks the 10-year anniversary of Fidelity Tactical High Income Fund. Regarded as a one-stop solution for your investment needs, its multi-asset construction is instrumental in navigating today's market landscape. How is the fund performing 10 years on? And how are new asset classes influencing the fund's investing strategy? Joining me today to discuss what's driving performance and where the team is finding new investment opportunities in today's markets is institutional portfolio manager, Scott Mensi. Welcome, Scott. Good to see you again.
Hey, Glenn. How you doing? Thanks for having me. It's always good to be here.
Excellent. And just a reminder to the audience, I have some questions, but the best questions are the ones that you send in. So please do use the Q&A function on Zoom. Now, Scott, 10 years, it's amazing how fast that's flown by. What sparked the creation of Tactical High Income? And what was the catalyst for its vision?
Sure. That's a great question. It's one we've been getting a lot as we approach this 10-year anniversary. I think first and foremost, most of what we do is client driven here at Fidelity. So there was a demand for something within our lineup that had a little bit more flexibility. I think when you look at Fidelity's lineup, 10 years ago, there are plenty of multi-asset class solutions, right? Strategic income, there's a number of different types of strategies, but one of the things that those strategies have is that they have what they call strategic allocations, right? So a specific band or range that they can invest in certain asset classes. And what we've heard from our investors is they like the multi-asset class approach, but they wanted something that was more flexible. So that's how we started thinking about this strategy. And when you think about where the returns come from in any given year, as we've often shown many of our investors, is that in any given year, you're probably 50% of the time, you're going to have something that's a non-traditional asset class leading the way. So that's something like high yield bonds, leveraged loans, emerging market debt, convertibles, preferreds. These are the things that are leading the way 50% of the time. So when we think about if you're going to have a multi-asset approach, you want exposure to all those different asset classes. And where is the expertise in Fidelity for that? It's within our team, the high income and alternatives division at Fidelity. We have a small group of analysts, well, actually not so very small, 20 plus, that are focused on those areas of the market. So the client demand for a tactical approach and the solution was found within a team that is already analyzing all these securities. And the way we do it is we make it a best ideas approach and put those together for investors. And it's resulted in great, strong, long-term results on both a risk-adjusted basis and an absolute basis as well.
Well, congratulations on that. And I want to ask you about Adam Kramer. He's the portfolio manager. Before I get to that, Scott, you're the institutional portfolio manager on this solution. Could you talk about how you work with Adam?
Sure. So, I'm here in Boston today. I sit, right down the hall from him. We talk about positioning. We talk about asset allocation changes, individual positions on a day-to-day basis. I meet with a lot of our investors a little bit more frequently than Adam does. I like to joke that I like to keep him in the closet doing his job, but he loves talking with investors. So I try to be the eyes and ears of the investor for him, and for the investors, I try to be, I like to say I'm not Adam Kramer, but sometimes I play him on TV. So we're a collaborative team. We talk quite a bit, not just about markets, but other things as well. So, he's become a great friend of mine over the last 10 years as we built this strategy and others within the group.
And he was an analyst, as so many portfolio managers, as they start at Fidelity, an analyst, and then become a diversified portfolio manager. When he was an analyst, how did that shape his thinking today?
Well, I think when the first thing, he often says this, and he showed me the note before, the first thing he ever rated was a convertible bond from a shipping company. And when you think about convertible bonds, they're somewhat of a niche asset class, but they're part of a corporate capital structure, and they offer really unique risk-adjusted opportunities if you're investing in them in the right times. So as he grew within the group, he became the convertible bond portfolio manager. He started running, and in addition to rating convertible bonds, he also rated high yield bonds, leveraged loans, preferred securities. And over time, he started to manage what we call our opportunistic high yield fund for the state of Massachusetts. So this portfolio can invest in high yield bonds, leveraged loans, convertibles, and preferreds. And that was really how he got his expertise into multi-asset investing in terms of on a security selection basis. Now, a handful of years ago, I want to say 2019, 2018, he became a portfolio manager on the strategic income funds. And so that's where he started to really fine tune his asset allocation approach, where he and Ford O'Neill sit over these strategies, which invest across 10 different asset classes in varying degrees, and understanding how these asset classes work in different parts of the cycle, how to gauge relative value. So, a culmination of starting as an analyst, understanding the securities, then moving on and understanding the asset allocation impacts. That's kind of how we got to where we are today. But a lot of what we do in this strategy is based on the framework that he built out and the team built out regarding convertible bonds, because there's a lot of similarities. And sometimes we joke that, this strategy is convertible bond 2.0.
Now, you mentioned Strategic Income. That's a fund that he's running with Ford O'Neill for U.S. investors.
Correct.
But of course, your favorite is Tactical High Income for us in Canada.
It is. It's as I said before, it's very flexible. We can do a lot of different things. And what I love about it is because of the flexibility, there's always something to talk about, right? There's always opportunities.
With Tactical High Income available here in Canada, you've got Ford O'Neill contributing to it. You've got Ramona Prasad and a whole host of analysts and others at Fidelity. And you alluded to it earlier, the team-based approach. This is a collaborative effort. Could you talk about that and then also talk about Ford and Ramona and how they work in partnership with Adam?
Yeah, sure. So, because we're investing in all these different pieces of the market, we have to be on top of obviously what's happening in these markets. So we have regular meetings with analysts across the complex, whether that's within our own group, the High Income Alternatives Group, specialists within the equity division, but also on some of those strategic funds. There are sleeves for things like infrastructure equities, commodity equities, REITs. You name the asset class, we have a expert that's looking at those parts of the market. So that allows us to meet with each of them on a pretty regular basis to understand what their best ideas are and how they are viewing valuation in their market. And additionally, we meet with all of our folks on our global asset allocation research team. They give us insights on where we are in the business cycle, what's happening more broadly from a macroeconomic perspective. We have an analyst that's just focused on inflation, on China. So these are all the inputs that we take in to try to frame our view as to where the bad news is priced in. And that's ultimately what we're looking for. Now, when we think about, Ford and Ramona, how they help with that process. So Adam works closely with Ford on the strategic funds, as I already mentioned, and Ford is really an expert on the investment grade bond part of the market, right? So he's been managing the total bond fund in the U.S. for multiple decades now, a long history of being a great investment grade bond manager. So we use his expertise when it comes to things like treasuries, investment grade corporates. When he's seeing valuations and opportunities there, we kind of talk through that. But we do have formalized meetings, but we've got a Teams chat that is going on constantly, so that if there is a valuation anomaly in the treasury or investment grade market, we can hear about it immediately. And similarly with Ramona, works with Adam and Ford on a fund in the U.S. called the Strategic Dividend and Income Fund, which invests in non-bond income, so dividend-paying equities, convertibles, preferreds, and REITs. So there's a formal discussion that happens as a part of that process with Ramona and the rest of the team. But Ramona is just the floor down below, and she's constantly talking about where she's seeing opportunities in her dividend-paying market, right? She's a dividend equity manager. I think some folks on the call might be familiar with her strategies in Canada. So she's a great input for us as we think about valuations in the equity world, where she's seeing value and income, and we take all of those inputs and build a portfolio that's with the best ideas from each area of expertise within Fidelity.
You mentioned the proximity of Ramona being a floor below. People may recall that our fixed income team is in Merrimack, which is about an hour or so north of Boston, and the equity managers are in Boston, but you rely on so many different inputs, it probably does make sense that you're located in Boston versus being up in Merrimack, doesn't it?
Well, it certainly does, because if you think about what we have in Boston, obviously the equity division is here, but 2 floors above me is the 14th floor at Fidelity, and there it's basically just conference rooms. That's where corporate management teams come in to meet with our analysts and talk about what's going on. And when we think about equities for one, but also those other asset classes I mentioned, convertibles, preferreds, loans, bonds, the underlying drivers of those asset classes is what's happening to their companies. So we need to have our fingers on the pulse of the companies, as well as what's happening from an asset allocation perspective or macro perspective. So what we like to tell our analysts in the high income and alternatives group, that even if you have even if there's nobody that you cover, like one of the issuers you cover here today in the office, there's going to be somebody that's tangentially related to your coverage that you need to hear that incremental piece, put that mosaic together so that we know where the risks are, where the opportunities are. So it's very important that we're here in Boston so we can have that constant touch with corporate management teams and know what's going on fundamentally.
It's interesting what you said about the different asset classes within a company's issuance. So when a company comes in to see Fidelity on the 14th floor, as you said, they may think they're talking from an equity standpoint, but we're actually there with teams analyzing all different types of issuance of that company.
For sure. And I'm not going to say the corporate management teams lie, but they are salespeople, right? They know their audiences. So when we can get both sides of the balance sheet in one discussion, right? Say the management team is saying, I really think we're going to increase the dividend here. The debt side of the balance sheet will say, whoa, whoa, whoa. That free cash flow is supposed to be used to pay down debt, not to pay distributions out to investors. So we get, I like to say, a more balanced discussion rather than having the, whether it's the CEO, the CFO, or the investor relations person, you're kind of playing to the audience, being the salesperson that they are. So that, I think, is an interesting aspect too. And in many times we might have the equity analyst, we might have the high yield analyst, and we also might have the investment grade analyst on the line as well. So you get three different perspectives that kind of frame that discussion. And like I said, we feel like we get a better, fuller understanding of what's going on when we can keep the management teams kind of honest about what they're doing and not being able to play up one side of their strategy.
Well, we're all glad that you're keeping them honest. A question just came in from the audience about Ramona. Curiosity if the portfolio component that she has within Tactical High Income replicates what they would know that she has within her other portfolios available in Canada.
Sure. So one of the unique aspects of, and that's a great question, it's one we get a lot. One of the unique aspects of what we do in the Tactical High Income Fund is that we don't use sleeves, right? So some of these other asset allocation funds that are out there, and even at Fidelity, will use a sleeved approach to asset allocation. Meaning, if we had an allocation to equities, which in this portfolio can be, 30 to let's call it 50%, 60%, average around 40 over a full cycle, we would be taking that percentage and sending it over to Ramona, and she'd do her thing, and we would just take her security selection and plug it into the portfolio. What we found is that given the unique way that we manage this portfolio, we want to be style agnostic. We want to be flexible. So we'll talk with Ramona and understand where she's seeing opportunities, and she will be a source and driver of places to look, but we won't necessarily match up exactly, right? So right now, for example, there are some, we've all heard about all the weight loss drugs and things like that, and that's having reverberations across multiple areas of the large cap world. I can think of consumer staples. I can think of healthcare. And, a lot of those ideas within that space, we might be bouncing those ideas off Ramona, looking at what she's investing in. Does this make sense for us if she's doing it? And sometimes there might be opportunities that might be in her benchmark that she needs to own because she is, managing to a benchmark, that we have a little bit more flexibility and might say, hey, I think there might be a better risk reward elsewhere. For example, sometimes we'll even do things intra-capital structure. So a while back, we weren't really excited about the bank stocks per se. So we invested in the preferred securities instead, where we thought we were getting better risk reward. So that might be a situation where we see Ramona looking at the financials and saying, oh, I like these names. And then us looking at the capital structure and saying, you know what, the stocks looks good, but I think we like the prefers a little bit better. So, there'll be some overlap, but it's not going to be a one-for-one kind of clone situation.
Well, that makes a lot of sense. Could you talk about and reflect on the evolution? When you think back over the 10 years, the performance has been very strong, but obviously, I'm thinking, what you did 10 years ago is very different than what happens today. There was learning along the way. Could you talk about the evolution of the investment process that's gotten you to the point you're at today?
Sure. I think, one of the things that I would say the biggest change that we've made happened after 2017 and in that period. If folks remember, it was a very similar, and into 2018 to some degree too, it was a very similar period to what we're seeing today, where you had technology really leading the way on the equity side, and you had equities, the best performing asset class, and investment grade bonds the worst. And we did okay during that period, but we were in many instances completely underweight some of those big, large mega cap tech names that really drove returns on the S&P 500. And if you think about what we're trying to do in the portfolio, we're trying to offer a similar risk reward that you get from a traditional balanced fund. So 50% S&P 500, 50% Barclays or Bloomberg Barclays Aggregate Bond Index. And at the time, back then, we were underweight and didn't own any of these tech names. So what we've done over the last few years, it implemented some rules to limit the underweights to certain areas, to the largest issuers in the S&P 500, so that we can get that proper tracking and give you that profile. And that's the biggest change, and it really has reaped rewards for us the last couple of years, where non-traditional income type stocks have really led the S&P 500, and we've been able to keep up pretty well because of that tracking and other security selection factors. We also put some limitations on and constraints on how we look at duration in the portfolio to make sure that we're not over our skis in risk as it relates to being too overweight duration to underweight duration, which again can be a driver of returns over time. And we always, like we said, we're always trying to give you that risk reward profile similar to the 50-50 balance fund, just with a premium yield and better returns. And having a little bit tighter controls on those two metrics has really helped us out. It was just an incremental tweak, but it's something that's made a big difference for us in these markets where you get the S&P 500 leading the way and the investment grade bond market at the bottom.
The tweaks, as you say, the flexibility are so important for us as investors to see you be able to do, and it's done, and you're able to maintain a low to mid risk rating with the portfolio. It's not like it's all over the place and causing something that may be perceived as a higher risk portfolio. How does that flexibility allow you to achieve lower volatility for investors?
Sure. So there's two big components that I'll talk about. The first is kind of the style at which we go looking for investments. So we always talk about trying to find the area where the bad news is priced in. So what does that mean? It means that in any given year, you're going to see the market in different asset classes price in different risks at different times, only to be changed and adjusted the next year, rightly or wrongly. So sometimes certain areas of the market will have too much duration risk priced in, credit risk, economic cycle risk, that sort of thing. So if we can find those areas where the bad news is already priced in, what that means is if the bad news occurs, our positions go down less than the market. If the bad news doesn't occur, we collect our coupon and we get some sort of capital appreciation, whether that's spread compression in a bond or multiple expansion in equity. So that's the first way. And that's kind of at the individual security level. Now, at the portfolio level, what we talk about is having the proper matching to the amount of income the proper matching of income to the amount of duration risk and equity risk we're taking on in the portfolio. So what we want to do is we run a scenario analysis to try to understand what would happen if the underlying stocks go up or down 10%, or the interest rates or credit spreads widen out by 100 basis points or tighten by 100 basis points. Do we have enough income in the portfolio to offset the potential downside to the equity and the bond pieces in those types of scenarios? So having that proper matching of income really cushions the blow on a downside. And if you look at asset classes like high yield bonds and leveraged loans, they've got great risk adjusted returns over time because they have that coupon that cushions the blow. So for today, for example, our yield, the yield in the portfolio, current yield on a gross basis is around, let's call it 4.5%. So hypothetically, what would need to happen for us to have a negative return, we'd have to eat through that 4.5%. Right? So that income provides that cushion, and matching that to the amount of duration risk and equity risk we're taking on has resulted in really good downside protection over time.
We should probably shift gears and go towards the markets. We're getting a few questions coming in about interest rates, currency, and so on. So we'll go to those in a second, but what's your view on where the market sits and how the portfolio is positioned to take advantage of that?
Sure. So, what we like to tell folks is we're not trying to make predictions, right? We're aware where we have to be cognizant of where we are in the business cycle. But, when we talk to our business cycle analysts, we are in the longest late cycle in history. It's not quite as long as the streak the Bruins have beating the Maple Leafs in the playoffs, but we're getting there. I had to throw that one in there, Glenn.
Yeah, I was
But
waiting.
so we're in late cycle of the business cycle here in the U.S. We're seeing actually some signals of mid-cycle right now. The credit markets have been pretty benign, right? So that seems pretty good. I mean, there are certainly areas that are overvalued, but the underlying economy seems to be kind of holding up okay at this point. I think so. So that's kind of where we are from kind of a business cycle perspective. Our view on where rates go, I think that's really, that's again a very hard thing to predict. I think right now with pretty high conviction, we could say we're probably not going materially higher, and probably the bias is towards the downside. But again, the market started to price that in at the beginning of the year, and clearly with the strength in the economy, things have kind of flattened out. So from our perspective, when we look at the markets today, it's, as I said before, it's very similar to what we saw in 2017, 2018. But the big difference now is that the yield component in some of the fixed income asset classes is much higher. So where we're looking today is more on the fixed income side of things. We're underweight equities and what I would say and investment grade bonds and overweight credit.
Why don't we talk about a few asset classes then? Then you've mentioned them leading up to this point, but maybe we can get into some more detail as convertibles. Why do they make sense in the portfolio, and how do you feel about them right now?
So convertible bonds are a unique asset class that have equity and bond-like characteristics. So that means, that historically, when you look at the convertible bond market, has a 50% sensitivity to the underlying equity and offers around a 2% coupon. So that means if stocks go up or down 10%, you get 50% of that move. Now, what's unique about that asset class is there's certain periods of time where you can get really attractive terms on those investments. And remember, they are a corporate obligation. They're higher in the capital structure, so they have lower volatility relative to equities. But in periods of distress or tightness in the financial markets, you sometimes get, you see things like the high yield bond market, investment grade market, loan market, they'll shut down. There's a lack of liquidity. And what we like to say is the convertible bond market is the last saloon in town when it comes to liquidity. And when we get into those situations, we can purchase these bonds. And if we're doing our work right on the credit side, we can get some really good terms. And if the market turns, we can get equity-like returns out of that asset class. So in the case of 2020, when we had COVID and liquidity tightened up, there's a lot of new deals that came to the market where we get really attractive terms, depressed equity prices, and for a bond to give you, in some instances, 200 type percent, that's kind of unheard of. So they offer this really interesting opportunity at certain points of the cycle. So we like to joke around and say, it's the secret sauce of the portfolio. But really, it's at specific times when we put them in. Today, not so much, not as attractive as maybe it was a couple of years ago. We're starting to see some new deals come to market, but from our perspective, the equity sensitivity for most of the market is really, really low. So it's not a great risk reward at this point, but we're looking at it pretty closely.
And what about leveraged loans, Scott?
So this one is, and I work closely with our loan team here in the high income and alternatives division, and I like to joke the leveraged loan market is the whipping boy of the financial press. I mean, every year there is something said that something's going to happen in the loan market. There's too much risk being taken, et cetera, et cetera. And what we've seen basically since 2022 is that, or even I guess starting in 2021, really, or at the end of 2021, loans have been the best performing fixed income asset class, over that period. And part of the reason is the coupon, right? Short rates have moved higher. This is a floating rate component, so it doesn't have the negative impacts from a duration perspective that other fixed income asset classes have. And with that short end moving higher, we're now getting 8-9% yields in many of these loans. So that offers a really interesting return. If we think about what happened in 2023, a lot of the market was anticipating, a recession, given that we were in late cycle and rates were going up, and those defaults really didn't happen. And as a result, you got 13% return out of the leveraged loan market. As we sit here today, we have seen price appreciation, but the capital appreciation opportunity is a little bit lower than it was previously, but the income component is still there. And if we are in this higher for longer camp, that should be pretty good scenario for loans if the economy stays strong. Now, even if rates go down inflation eases off, you're getting about 100 basis points more in yield relative to the high yield market. So you're already getting paid for that risk, we feel, relative to the high yield bond market. So, it feels pretty good to be in loans today, especially if we even consider as well that they're at the top of the capital structure. So that means if anything does go bad, we're first in line for the company assets in kind of a restructuring scenario. Obviously, we're trying to avoid that, but that structural advantage versus high yield bonds has historically resulted in lower volatility to the high yield market. So today we're getting a premium yield relative to high yield bonds, and we also have that senior security aspect as well. So that makes us, makes that asset class still look pretty attractive, even though it's had a couple of good years here and it's been the leader in the fixed income world year to date.
You made a very algebraic statement. If this, then that. It leads me to a question that came in from the audience, and it has to do with, I think, for both you and Adam, what's keeping you up at night?
Yeah, we like to joke that we are the chief worry officers of our funds, right? So everything really keeps us up at night. But I think, ultimately what's going to drive returns in most of the asset classes we're investing is where we're going in the business cycle. And, and we're trying to really, within our group, the high income and alternatives group, which obviously our companies have, I think, more exposure to higher rates. That's an area we're really focused on. How long can a lot of these businesses survive with rates staying at this level? We've asked our analysts to look at that a number of times to try to determine, where are the weak points, right? At some point, free cash flow could decline if the economy slows, and then what happens to interest coverage and those sorts of things within, the companies themselves. So that's, I think, what I would say would be one of the things we're worried about is how long can the economy sustain itself in a high rate environment. There are other sides of that coin that say, well, maybe productivity is increasing in the US, so maybe that's okay if we were at the higher rate environment, and that's part of the reason why we're at that higher rate environment. There's obviously the geopolitical risks that are out there. Those are really tough to handicap, but we do have some positions in the portfolio that we do think offer some hedges there. We have some gold miners. We have some shipping, some oil tankers that offer some geopolitical hedge aspects to them. So there's certain ways to hedge those risks, but I think what we're focused really on right now is where is the economy going and where are the signals that would tell us that, that R word is approaching. And right now, we feel pretty good on that, but that's why we have all of our analysts to make sure whenever they meet with the companies, what's happening with your customers, what's happening with your margins. Those are the things that we watch closely as we move through the cycle.
Thank you for that. From my recollection, Fidelity has about 45,000 people around the world as employees, and a large number of those people are focused on investment management. Can you give us a couple of ideas of what might lie ahead as an asset class that you could choose for tactical high income that maybe you don't have yet, or could you allude to some areas that might be the future of investing for this fund?
Sure. Yeah, sure. So within our team at Fidelity, we have we've recently branched out into the private credit world, so direct lending. So we have a team of folks now based out of Chicago that are running a direct lending business. So what direct lending is lending to companies, smaller and middle market companies. So not kind of the big companies that everybody would see, on CNBC or Bloomberg or pick your financial television or news source. So that's one area. Those loans, they float as well. They're typically higher coupon and have actually probably better covenants than some of the the leverage loans that we're investing in, kind of on the broadly syndicated side as we talk about it. So that's an area. But again, that higher coupon comes with less liquidity. So you have to take that into context as well. We've also looked at covered calls. We do that in this strategy that we have in the United States, the Fidelity Multi-Asset Income Fund. So potentially adding that into the Tactical High Income Fund. And then a new opportunity within our group is CLOs, collateralized loan obligations. So that's a big part of the leverage loan market. And that's an area where we've added resources at the firm here in Boston to help bring that business to our group. And we've seen some of our funds outside of this one start to invest in that part of the market. So always looking for new ideas. And if we find something compelling, Fidelity is more than willing to put money towards those resources to make sure that we can put them into the portfolio in a way that helps our unit holders.
Perfect. Thank you. Scott, we've only got a minute, so I'm going to put this together as a wrap and basically say that the fund has been a multi-award winner. Fund Fund Grade A+, Lipper Awards. Even recently, as in a balanced category, #1 seller in RSP season, beating 99% in its category since inception. And there's even an ETF coming out on May 22nd. You've highlighted and you've underlined that multi-asset investing makes sense for everybody as a portion of their portfolio. And we thank you for speaking with us today, Scott.
Happy to be here. Always glad to talk with our Canadian investors.